In this week's update, why even good tips are rarely profitable, how to get better results than the rest, and managing your psychology in volatile markets. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. Well, look, it was a very volatile week, as I'm sure everybody knows. So let's have a look at what themes were actually driving the market last week, and particularly on Friday when the US market sold off very heavily. But there's some strange things happening in the US. Now, seasonality in September is just about the weakest month of the year on a long-term historical basis. So seasonality, to a fair degree, can become self-fulfilling in the absence of other major drivers. And I think that's part of what is happening at the moment, because the data and the facts certainly don't really support the price action that we saw last week in the US market. Not on face value anyway. So I think seasonality is playing a bit of a role, which is good news because the US market was a bit overdone. So a bit of a pullback is actually quite healthy as long as there are not other factors that are going to prolong and deepen that pullback. But I think it's safe to say that the perception, rather than the reality, the perception of reward for risk has shifted to being more negative, more unfavourable for equities. There's no question about that. But perception and sentiment can turn on a dime. So that could all change next week or next month or November. So, I'm not making any prediction there. I'm just making the observation that there has been a quite abrupt shift in sentiment. It may be quite transient. It's my understanding from those commentators that follow this very closely that there is 100 basis points of rate cuts now priced into the bond market. And that's happening at the same time as we've got quite high valuations. Now, the Magnificent Seven stocks, the valuations are starting to come out of those at the moment. And those valuations are higher than normal, but they're not excessive, really, when you look at the growth. The question is the growth going to slow dramatically because these mega stocks are going to be pulling back on their huge AI investments? And the answer to that question is one that really is an unknown at this point in time. Fund manager positioning remains bullish. Now, that can be seen as good news or bad news. The good news is that they're still bullish and supporting the market. The bad news is if they need to unwind because circumstances are changing, then there's significantly more downside to come. And again, this is a question that we don't know the answer to. So how do you deal with a situation where we have more questions than answers? And of course, and I'll come back to this in coming slides, it's about process. You've got to be able to fix on a process and shut out the noise, otherwise you just drive yourself nuts. So you've absolutely got to have rigorous process during these sort of periods where markets are transitioning from a relatively high value to something else. And of course, the debate at the moment is this battle between a Fed that is now quite clearly saying that it's ready to cut rates. And I think it would be, if the Fed doesn't cut by 25 basis points this month, there's going to be hell to pay. So they need to do at least that. The possibility of them doing 50 basis points, it's not warranted, as we'll see in a minute, but they may well do it anyway. So there's that battle between that situation, which is generally good for stock markets, and the fairly rapid cooling of the hype around AI. And there's no question that that's coming off the boil, and it's been precipitated by the quarterly results of all the majors, all the tech majors. And there's no question that their results are cooling and their outlooks are cooling. And we saw a 10% fall in Broadcom, which is one of the world's biggest semiconductor stocks, on Friday night. And that is sort of casting a bit of a negative sentiment over the market. Now, I just want to address the topic of seeking out tips and sector forecasts from various sources. What a lot of investors who have limited time, this is not a criticism, this is just the way it is. They've got limited time, they've got limited knowledge, and so a lot of investors think that what they need is tips from experts about the next big stock, the next big sector, what the next theme is, something you can just dump your money into for the next 5 years and it'll be all good. Now, the problem with that, I mean, it sounds very easy and it sounds appealing because, the supposed experts are supposed to know what they're doing. They're supposed to be all over this, and their recommendations should be better than most. And in a lot of occasions, those recommendations can be quite solid, but there's also a lot of rubbish in there. I get a lot of feedback from potential new members who are completely disillusioned with what they've been doing about getting tips, seeking the next big thing. It's natural to think that way because it's us being us. It's doing the only thing that we know how to do. So, please, I'm not being critical here of anybody. It's just absolutely normal and natural. But by definition, this process sets you up to fail. Going out and gathering tips or recommendations in the isolation of other information is setting you up to fail. And all that you're left with is your emotions. That's even if you're tracking stocks. Again, I get feedback from plenty of people that they bought into this stock 2, 3, 4 years ago and it's gone down significantly and they just lost sight of it and they didn't really know what was happening. And now they're really in strife because they're looking at a very significant loss. So it's just not a process that works. And it does, in a way, set you up to fail. And here's why it does that. Because recommendations and tips, and this is the basis of most services, they don't provide any exit or trade management information along the way. What sort of weightings are suitable for that stock at this point in time? Where should you start to take profit? Where should you get out if things don't go well? So in the absence of that information, the entry information in the stock selection it's not useless, but it's not that helpful because no stock can ever be put on autopilot. No stock. It shouldn't be done. And in my opinion, gathering tips without a process to plug it into is worse than no tips at all, because what it does, it gives a lot of people a false sense of security that they've actually got a portfolio that is going to deliver or should deliver. But if you don't have the trade management and the exit information, then you don't have an investment process at all. So that's the way that I see it. That's the way that the feedback that I get from talking to many, many people who are desperate to find a way to get better results. This is what does work, and I touch on this almost every single week. It's about clarity of purpose and process. And before you yell, here he goes again, but it's just so important. You've got to find a process that is suitable for you. There is no one size fits all. You cannot just take someone else's process and expect that it's going to work for you, because it's probably not going to, because everyone's needs are different in certain respects. So you've got to be able to develop a process that's suitable for you. And that's certainly, something that I spend a lot of time on trying to assist members with. Getting a sense of roughly what your portfolio should look like. What are the style of stocks that are most suitable for your needs and your personality? It's not a difficult thing to do. I know it's difficult if you've never done it and you just don't know where to start, but it's actually a very simple process. You need to understand what your exit triggers look like. We don't know what the exit prices are going to be, but we need to know what the exit triggers look like so that when they come up in the future, we can act without emotion, because it's part of a process. You need to be able to manage weightings over time. And again, there's a very simple process for doing that, but it's not something that comes naturally to investors. And you end up being led by your emotions, which will tend you towards selling low and buying high. It's just the way it works. It's how we're wired. So how do we go about capturing a good portion of the trend in a repeatable sort of fashion? Because the reality is you're not going to be able to buy and sell at the very extremes, other than, with a spot of luck here and there. If you think you can buy almost at the bottom and sell almost at the top every time, then you're delusional. It doesn't happen. So the answer is settle into a repeatable process of buying and selling that works, that captures a good, healthy slice of the trend, keeps your capital safe, but leaves you exposed to the very best trends. And again, it's a very simple process. It's just not easy to do. It's not easy to do because of what's running around our head. So it's so important to start to think differently if you are not getting the results that you want. It's not easy because you just don't know what you don't know. You've not had the experience, the time, the expertise to do any of these things. So it's not easy from perspective. But make no mistake, it is a very simple process that I step members through. And we tend not to miss things because it's the same process each time. And I think for most people, they need a mentor for some of the journey, for just about everybody, because at the early stages, you have more questions than answers. In fact, you probably don't have too many answers at all. And I just want to show a couple of examples. I want to look at Mineral Resources, JLG, or Boss Energy, just as an example to highlight what I'm talking about. So if we look at Mineral Resources, if we go back here to December, the end of 2022, this was an absolute market darling with good reason. It looked bulletproof, founder-led, incredibly successful company, and it just didn't look like anything could really go wrong. And even here, back in May of 2024, where there was a significant run-up, things still look pretty good for Mineral Resources. Part of the reason for this decline was the negativity that settled around lithium, and some of the lithium upside had been priced in here, so it was natural to see this sort of pullback. But in May of this year, it was unfathomable when Mineral Resources was trading $75, $80, that within a few short months we'd be trading at $30. Inconceivable. And I'm sure that a lot of investors have hoped through this whole decline from 80 to 30 that we'd get a rebound. First of all, it just made logical sense that we get a rebound. But when markets are behaving like this, most of the time it doesn't work. So, what is your process? What are the essential skills that are required? And these are the key ones that are required. You've got to be able to tell the difference between a temporary price drop and something that is more serious and lasting. At what point in this decline did it become obvious that we now had something more serious and lasting? And we were in Mineral Resources in the Insiders Club portfolios, and we had done extremely well out of it, but we did exit on the way down. So we didn't get out anywhere near the top, but we certainly got out with a partial position in a profitable situation. The second thing that you need is a continually refreshed perspective on what is changing and what not to fret about. So again, telling the difference between something that's just temporary, it's passing, it might just be the market going through a bit of a negative phase, and you can stay on board. What is really a great business destined for ultimate stardom and what is simply hype. And that all leads to a process that's going to keep your capital safe. Not trying to get in at the bottom, not trying to get out at the top, but just working the process in a way that allows you to capture parts of the gain and then get out and look for the next opportunity. So that's Mineral Resources. If we look at Boss Energy took a long time to get going, but finally the uranium situation turned around. It looked obvious from 2019, but didn't really take off until 2021, 22. The price of Boss Energy probably got ahead of itself, but now we've had a very sharp turnaround in sentiment towards the uranium sector, and the price has gone from the highs around $6 down to $2.45. Now, again, we did incredibly well out of Boss Energy, many, many hundreds of % gain, but we exited because there's a process that guides what we do. The final one I just want to touch on, this is JLG, again, a stock that was a market darling. We ran from $1 in 2019 and we got up to over $9 in 2021 and again in May of 2022. We then pulled back. That was probably, the price ahead of itself. PE ratio is far too high. And so we got a consolidation, a lengthy consolidation, which is warranted. And sometimes those consolidations can be 2.5, even 3 years. But the expectation was that when this consolidation completed, then the price would regain its uptrend. But of course, the last set of results have shown that there is considerable difficulty that the company is encountering. And it has fallen very sharply from around $5.50 and closed the week almost $3.50. Again, we got out of this situation for a very modest loss, and we're now moving that capital into other more attractive opportunities that are going up. So it's just about staying on top of what can be a changing fundamental and technical situation, because all three of these at various points in the last 3 years were absolute market darlings. And if you just pigeonhole it and leave it, then you might wake up one day and find that the share price has been absolutely smashed. So you can't afford to do that. And that is why seeking tips, recommendations just does not work. You have to have the whole picture, the whole process, and it needs to be periodically updated. Okay, I just want to touch on a couple of months ago at the end of June, I showed you the results of the fund manager. So this is a fund that I'm involved in. And I just wanted to update the results because we've had a tricky couple of months. July and August have been pretty tricky. We've had a couple of severe volatility bursts that I'm sure have, in fact, I know, have created a great deal of uncertainty and confusion for investors. So this is the return to the 30th of August. So it's 34.02% is the return to the end of August. So at the end of June, for the period from April 2023 to June 30 was 29%. So in fact, the fund has moved forward another 5% during those 2 months. Why April 2023? The fund has been operating since 2020 and is showing a total return of around about 62% since inception. But from April 2023, there was a significant shift in the methodology in which the fund was managed, particularly embracing the stocks that have over time proved to be really, really exceptional wealth compounders. They're always expensive. They tend to be stocks that I had struggled to buy because of the perception around the valuation. But once you start to embrace that these sort of really gilt-edged long-term wealth compounders are just going to keep rolling on with a very high degree of probability, then the results for the fund have certainly improved quite sharply. So that's where we stood at the end of August, up from 29 to 34% in the last couple of months. What's standing behind that? Well, it's what I talk about in the Sunday video every week. You've got to have detailed research that feeds into a clear plan. It's the same process, so that you don't miss things. You just got to be very clear about what boxes need to be ticked. And again, this is something I talk about regularly. What are the boxes that need to be ticked that tell you that something is a great business? Then they're things like pricing power, that they dominate their niche. The management are great allocators of capital. They have a huge and probable runway for growth. All these things that just don't come up. If you're doing scans on fundamentals to try and find opportunities, you don't find any of these things in those scans, but these are the things that really matter. So they're all the boxes that need to get ticked. The basic premise around the fund is that myself and the fund administrators take care of virtually all the tasks. They're individually managed accounts. You've got full visibility and control over those accounts at all times. We only focus on the highest quality growth stocks that we can find. It's primarily in Australia, but some US stocks. And if you want more information on it, just get in touch with me and I'll be happy to run you through. All right, moving on now to the American stocks. The S&P ended up down 4.2% for the week and the NASDAQ 5.2%, so a nasty week. That's one of the worst weeks we've had in a couple of years. The equal weight S&P was down 3.1%. The Russell was down 5.5%. So a nasty, nasty week. And I would expect that our market will open with quite negative sound on Monday morning. Now, the thing, though, about the American market is that if you look at it on a sector and on an individual stock basis, most of the selling was in big tech and discretionary sectors. A lot of the other sectors, yes, they finished negative, but only mildly negative. And there were quite a few stocks that I identified in looking through 100 or more US stock charts on Saturday that either went up slightly or didn't go down. They were very resilient to the selling. So don't be too put off by what you're seeing at the index level, because a lot of that was about Amazon, Microsoft, et cetera, which sort of belays the relationship between the jobs report, which supposedly is what spiked the selling on Friday. The jobs report and big tech, to me, that's not a direct relationship. Big tech shouldn't be selling off because a little bit of a mixed job report. Big tech is being sold off for other reasons, and it's essentially valuation reasons and perhaps a slowdown in their business activities. Now, the data was mixed on jobs on Friday night, and we've had a series of jobs data over the last few weeks that have caused the market to, get a bit upset with things starting on the 5th of August. But it doesn't equal a recession. So just a few things about that jobs data. Virtually all the growth in the labour force is coming from immigration when you look at the numbers. The number of people employed went up 168,000. The number of people unemployed went down 48,000. So the new people that are coming into the labour force are getting jobs. Some of the people who are unemployed are getting jobs. So that means more jobs, and they're also getting them more quickly. The unemployment rate eased back from 4.3 to 4.2, which on any historical level is low. 4.2% unemployment is pretty close to what economists call full employment. And on top of that, wage growth month on month was up 0.4%. So that shows that there is still strong demand. Otherwise, wages would not be going up. So the August jobs data doesn't warrant the Fed to cut rates by 50 basis points. But the market is screaming for it. So if the Fed doesn't move in September, there is, as I said earlier, there's going to be hell to pay. If they go 25 basis points, I expect the market will be disappointed and we may get some further selling. If they go 50 basis points, then that's probably about right. That's probably what the market is expecting. And particularly if the commentary that goes with that indicates another couple of rate cuts by the end of the year, then I suspect the market may be happy and that this decline may be short and not too deep. But look, the jobs data, so that's the very short term, but the jobs data is showing signs of slowing growth. So it's possible that in calendar year 25, we could get some sort of mild recession. It's possible. So I wouldn't write that off. And that's why the Fed needs to cut rates. So the jobs data at the moment does not warrant the Fed cutting rates. But you've got to remember there's a lag effect here. So the Fed has got to get ahead of the curve. So if they don't start cutting rates now, the risk of recession in 2025 go up significantly. And I think the market would start reacting badly to that. Now, just a point, because I've had a few questions in the forum that rate cuts generally happen at the same time that the stock market peaks. That is partly true. When it's rate cuts that are associated with a looming and actual recession, then that tends to be bad for stocks, and significant peaks in the market can form. But when it's rate cuts without a recession, and there is still a pretty good chance the US economy will not slip into recession, when those rate cuts happen without a recession, then generally the stock market is fine. So again, don't just swallow the headline that rate cuts are the signal that the market has peaked, because it's just not valid. It depends on recession. At the moment, I don't know what odds you'd put on it, but it's certainly not a done deal at all. I think what's happening at the moment, the predominant driver of the market, is that the hype we had around AI, the incredible buying by fund managers, probably reinforced by the yen carry trade, it's starting to deflate. The premium from that is starting to deflate. Now, that becomes an unpredictable situation. How quickly will it deflate? How much will it deflate? Because it depends a lot on leverage. A lot of people, a lot of institutions will be forced by leverage to sell things they don't otherwise want to sell. So it makes the next month or two quite unpredictable. And again, just reinforces what this whole video is about. It's about having a process to deal with volatility and unpredictability. Now, the US dollar index was lower, 101.19. The 10-year yield fell down to 3.71, but the VIX spiked above 20. We haven't been up there since we were very briefly there in early August. All right, look, I've done an awful lot of scene setting, but I just thought it was so important because you'll be getting bombarded at the moment, I'm sure, by lots of media hype around what's going to happen with the market. This is the S&P on a daily chart. You can see we had sharp selling on Tuesday, so it was a shortened week, sharp selling Tuesday, sharp selling, very sharp selling on Friday. So it was a pretty nasty week, and our market certainly will react to that. But as far as parts of the Australian market go, I think it'll be an opportunity. So I'm actually looking forward to the opportunities that may get offered up in the coming week. This is the NASDAQ on a weekly chart. So again, as sharp as we saw over here in mid-July, when this whole process of AI deflation, if you like, or deflation of our stocks started. So we've had a sharp move down to the 50-week moving average, or call it the 200-day moving average. We got a bounce, but since then we've rolled over again. So you'd have to say the odds at the moment favour at least down to this level here, 16,680 on the NASDAQ, and quite possibly we could get down into these areas below 15,000. So I think you've got to expect that September is going to see lower indices, but that doesn't have to mean lower prices for your stocks. You've just got to be in the right sort of stocks. Semiconductors, always important. I said several weeks ago that this downtrend in semiconductors will get overdone. It'll go too far, and I don't think we're at the bottom yet. In fact, we're not at the bottom yet, given the outlook statement from Broadcom on Friday. So I'd expect we've got more to go. Whether this is the bottom here, just under 200, or whether we might come down further, remains to be seen. I know what the entries look like that I want, in the same way that I know what the exits look like. I'll know when I get there. So that's not looking terribly rosy either. And they're the US sectors. So everything down. Energy down very sharply with a very sharp plunge in crude oil. Communication services came next. Materials, technology, very sharp selling in technology. But look, everything got sold. There was really nothing spared last week. In Australia, information technology is doing very well. This is about the merits of stock selection. There are a couple of major contributors to this index that are doing incredibly well for very good reason, because their results were excellent and their outlook statements were excellent. And they've really performed and they've held up our index. And this really doesn't have very much at all to do with AI. Finance continues to defy all the odds, all the logic about valuation, and is still heading to the upside. Commonwealth Bank is awfully expensive. I couldn't buy it with my worst enemy's money, but it still seems to be gaining a lot of support in the market. Pretty much everything else, it was a very sad story. Energy down very, very sharply. So too materials, healthcare, just going sideways really, and small caps certainly well off their highs as well. So it's not a particularly rosy picture. There is the equal weight S&P on a weekly chart, down less than the S&P, but the Russell certainly, if we put this on a weekly, you'll see it more clearly. That was almost as sharp a week down as we got at the start of August. So that is where we sit with the US market. Turning now to Aussie stocks, the Aussie dollar was lower at 66.07. Our market fell 1% across the week, but will almost certainly open sharply down on Monday morning. Now, small caps have been fairly difficult since COVID, since 2020, 2021. We had a bit of a surge there, a bit of a relief rally after the COVID crash. But by and large, small caps have been fairly difficult. And there remain stocks that offer terrific value, but they're just not really wanting to go up. But having said that, there have been a pretty decent number of stunning winners, and I'm not talking speculative stocks. You'll always get some speculative hype around small stocks, perhaps driven by announcements, driven by social media. But I'm talking about the small caps that have got a great business, a great enduring business for the future. And the market finally wakes up and recognises it. So there's been some stunning winners, but there's plenty of others in the background. So what do you need during a time where the US market is probably going to be tested? What do you need? Will more tips do it? And hopefully you've accepted what I said at the start. Tips in isolation are just not going to do it, because you're just missing out on all the key things that you need. Rate cuts on their own are not going to do it. You need research, you need a process, you need to be identifying just the best of the best. That's how you go about it. Precious metals, gold, dropped another $16 again. I think this is a lot about the uncertainty. Will the Fed go 25 basis points? Will they go 50 basis points? Just what will they do? That's creating uncertainty. So gold was down, even though the US dollar was down as well. In Aussie dollar terms, our Aussie dollar did fall along with the US dollar. So that actually helped the Australian dollar gold price, and it actually bounced. I think it was 3,700 last Sunday. It's down 3,729. But silver did underperform. It's now back down to 28. If we look at precious metal stocks, GDXJ was hit fairly hard. The global stocks, despite the buoyant gold price, are not doing all that well. But some in Australia are doing spectacularly well, but they're a minority. You've got to know where to look. And they're still roaring. Let's have a quick look at first of all, the ASX 200 for those that are interested. So that's where we finished on a weekly basis. Looks very, very tepid, but I would think we're going to have a bit of a red candle to start next week. Moving now, there's silver. So silver still caught in this range between 26 and 30. In US dollars, down just a fraction, but clearly a very strong uptrend. And that's why the lack of movement on global gold stocks is a bit of a mystery. In Australian dollar terms, we're holding near our all-time highs. And just a quick look at GDXJ. So fairly sharply down for the week. Okay, turning to other commodities. Copper was down, nickel was down, and the situation we've got at copper feels very much like what we had with uranium in 2019, 2020, when higher prices just looked absolutely inevitable. They looked a complete no-brainer, and in the end, it took several years, but in the end, that's the way it played out with uranium, because there was no way that additional supply was going to be switched on or developed unless there were higher prices. And it's the same with copper. The demand for copper, or the supply of copper, is not going to be met unless there is a significantly higher copper price above $5 to warrant that investment. It's just not going to happen. And BHP is saying that they expect that we'll see those higher copper prices in the last third of the decade. So they're talking 2027 to 2030. So that's BHP's timeline. And of course, we know the market will start pricing that into copper stocks maybe a year or so in advance. So it could well be that we've got another 18 months to 2 years where the market is just struggling with investing in copper stocks. But look, it could happen next week. Who knows? So again, you just need to know what it is you're looking for. What are the type of stocks that are suitable for you? And what does the entry look like? You don't want to put your money into something that's just going to sit and look at you for the next 2 years or may even go down further. You want to be using your capital somewhere else. So what does the start of a new upcycle look like? So the question is, how do we get from where we are now into the latter half of 2024, how do we get to 2026, 2027, when it's highly probable we're going to start to see copper stocks come back into favour? And how to get there in a manner that's acceptable to you. So that's the trick. From my perspective and what I've been doing for years is I just focus on the best of the best. And in the copper market in Australia, it's actually very challenging to find really good options because, most of the good options have already been bought out. So just focus on the best of the best, and that will give you a much higher probability. Crude oil was lower, 67.67, so we've moved down very, very sharply. There's the copper chart. Not a lot happened to copper during the week, but you've got to remember that the US dollar did go down. So for copper to slip a little bit, it wasn't particularly great either. And there's the crude price. So the crude price has now broken 70, which would be above all year. So all of the year's gains for crude are gone. And then if you're looking at energy stocks in Australia, you've got the problem that energy policy in Australia is just a complete dog's breakfast from all sides of politics, just hopeless. So I find investing in energy in Australia pretty much off limits because there's just nothing there that gets me excited. All right, wrapping it up, some of you regulars might recognise this from a couple of weeks ago, and that is that above average returns can be achieved, but it's not a free lunch. You've got to step up and do a bit of work. You've got to get organised. You've got to have a process that improves your chances dramatically. You don't have to be a victim of what the market dishes out to you. Market goes down, you lose money. It doesn't have to be that way. You can do things to improve your situation. But you've got to get organised and you've got to have a process, and most people really don't know where to start with that. Hence, we come back to the concept of getting a mentor for part of the journey. You need to take a fresh look at what you're doing, because if you're getting less than desirable results and you keep doing the same thing, then guess what the outcome is probably going to be? Ask yourself the question, are you buying just the best and the highest probability growth stocks you can find, or are you just accumulating tips out of context? Are you able to buy with confidence, knowing that there's a very high probability the stock you just bought has got a very rosy future? And if you're worried about buying into stocks that have just doubled in price over the last year or two, then just remember a study done by JP Morgan that said investing cash when the market is high is unlikely to produce lower returns. But again, that has to be fine-tuned down to what particular stocks that you're investing in. So are you operating in a haphazard manner, or are you operating by design? That's the question. If you need help, there is plenty of assistance available. Portfolio Analyst last week was taking stock. It's essentially a learning exercise done at the start of each month. We looked at stocks that were offering very valuable lessons, particularly ones that had been under discussion during the month of August. And we also looked at mining services stocks as well. All right, that's it. Been a long video today, but given what's happening in the US market and the way things may proceed for the next few weeks, then I thought it was particularly important that viewers would not only want the detail, but they'd want to get a greater understanding of why markets are doing what they do. So hopefully you've got that. There's more information on the website. There's my email address. And I'll be back with you next Sunday, and I'm sure it'll be a fascinating week. Cheers.